Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 13. And today is going to be part 2 of what we discussed yesterday. An episode that I think so far is my favorite of this season, just because I think we're actually using numbers. Because at the end of the day, being an investor is all about looking at numbers and let the numbers do the talking. Because we've been stressing about the fact that you got to take your emotions out of it. And I know sometimes it's easier said than done. At the same time, though, this is just one of the main reasons why I still need a coach and a mentor to guide me every step of the way, because I get it when it comes to achieving our financial success, we get emotional about it and we should get emotional about it. However, what I'm suggesting here really is the fact that getting emotional about the numbers is actually one of the biggest and fastest way to get ourselves into financial trouble, which really goes against what we wanted to do this in the first place. And by doing this, I mean learn how to invest and actually investing. And so I want to continue on with from the episode that we just had, which is stop buying and start investing in real estate. Now, if I'm appearing a little thrown off right now at the moment, I am, because last minute I had a bit of a technical challenge here with the camera situation. So for the very first time, instead of using my computer, which is now on this side, I am training myself to stare into the camera, and that's my phone right now. So it's really weird because I'm not actually able to see everything at the same time. So bear with me if you're kind of seeing me looking around a little bit, because I'm just double checking to make sure that I'm still in the frame and everything that I'm doing, you can still see properly. So with that said, though, I want to continue on with this example that I had yesterday. And this little example is from my own principal residence, my very, very, very first home principal residence, which was a pre-construction condo. And I used a 20-year example here. So if you actually did not watch season 3, episode 12, I would actually recommend that you stop here and go back to watching episode 12 first, and then you can come back here and continue with this, because I think that's going to be much, much better for you in terms of painting the proper picture and building the best context that you can have. Because again, context, in my opinion, is everything, because I understand things get taken out of context so much, especially in the world of investing. And that's also why investing is inherently different from buying, especially when it comes to leveraging real estate as an asset class. Cannot stress that enough. So if you are hearing me like a broken record over time, good, because that means it's starting to register. However, I really need that voice to be in your head, because I needed that voice in my head. Otherwise, I would have gotten myself into more trouble than I already have so far. And so I really wanted to share something with you. It's the fact that, yes, you know what? A lot of you guys, I've got some DMs in the last 24 hours now at this point going, Tim, come on. I mean, where are you going to go, especially in the Canadian market? And my Australian audience, I got something from you guys too. It is very challenging for you to find something like that. And that is just it. Okay. And some of you send me some really nice messages, especially when you're from the Vancouver area. You recognize the fact that, you know what, had you actually buy something in 2004 and you're looking at the value today, where's that value today? I mean, it was about, like, as I mentioned, I believe it was right here on the third page, about 800,000. Okay. Now, buying something for 250 and 20 years later, or 19 years later, rather, it is worth $800,000 is not realistic, and it's not applicable in every single market. And thank you for saying that, because that is exactly my point. Because yesterday we already talked about the fact that had you not been in a major metro market where it had seen dramatic increases in value, you're probably actually not even getting ahead. Why? Because of inflation. And so $250,000 back in 2004, at least for Canadians, what that means is that same $250,000 is worth $361,000. Okay. And after all is said and done, let's just say that your rate held at 4.54, as mentioned yesterday, paid down over 20 years instead of 25 and 30, because if your amortization is longer, what that means is you actually end up paying more interest too. And so what that also means is, even though on paper it looked like you were paying $250,000, after all is said and done, in just 20 years, your total cost of borrowing plus what you actually put in there is $354,709. And so if you look at those two numbers and just compare those two, you're not exactly getting ahead. You're not exactly getting ahead, if you did not get into a major market. Okay. And I know not everybody can afford to get into a major market, first of all. And second of all, it's just not a universally applicable scenario. And that's what financial education is all about. These concepts, kind of like old age wisdom, they are supposed to be universally applicable, meaning it doesn't matter which market you go into. And this is why we keep on stressing the fact that when you have the financial education, when you actually are trained properly in multiple strategies, it doesn't matter if the market is going up or going down or going sideways for a long time, you are able to profit and continue to build upon your income streams and long-term wealth. And so coming back here though, as I mentioned, the example that I gave is that I did some research and these properties are now getting not even sold because I didn't have the data into that. However, I saw two listings in my old building, and one is asking for $700,000. The other one is asking for $800,000. And if you're an educated investor, you understand that those numbers mean nothing. And again, it also depends on if you're in a seller's market or a buyer's market. Regardless, based on the data that I have, and again, all I really want to share is that thought process, because it could be accepting multiple offers and it could be overpaying, asking. At the same time though, what it's telling me is that if one is asking for 700, the other one is asking for 800 for the same product, chances are it's not overly a seller's market. Okay. And so coming back here, I'm just going to say that during COVID, everybody remember, during COVID lockdowns, especially when everybody was looking to upsize, and all of a sudden, even though the first 3 to 5 months since lockdown, the market kind of went down quite a bit, and then it took a very sharp turn because everybody wanted to look for something bigger. This was a 900 square feet condo, 2-bedroom, 2-bath in the lower mainland British Columbia in Canada. And so if you're in cities like, again, Sydney, Australia, LA, Seattle, New York, Chicago, Toronto, London, then you understand that's big square footage. That's a lot of living space. So a lot of people are moving from 300, 400, 600 square feet to 900 square feet. That's a big upgrade. And so with that said, at one point, the selling price, not even asking price, the selling price for this particular unit with this type of places was going for about $900,000 to $925,000 back in 2020 and 2021. And so I remember my mother asked me at one point, well, how much would that place have been now had I not sold it back in 2010? And at this point, my answer was, you know what? It would have been a bit over 900,000, but let's just be conservative and say 900,000, because again, if I were to sell it after all is said and done, remember, we've got to pay fees and commissions. Probably would have taken home less than that anyway, but I'm just going to say 900,000 is it. I sold it for 400,000. Now I probably would have sold it for 900. That's a $500,000 gap right there. However, I want to remind everybody right now, and this is my personal story as I keep stressing, is the fact that I sold this property in 2010, end of 2010. End of 2011, I started to become a trained and professional investor actively. In 2012, July 25th, 2012, I declared financial freedom because I had a little bit of seed money when I sold that property. And so once again, let's say I think this was 2021 when I had this conversation with my mom. So this is now 9 years later since I declared financial freedom, and also 10 years later since I started investing like a professional. So really, it took me about 25 months, as I keep saying, because I did start my education in January 2010. So this is why in my story, when you hear me in public stages, I always share it took me 25 months in total because I do count the time that I'm learning as part of that journey. Because so many people, they want to learn something over the weekend and go out there and start applying on the Monday. And in most cases, it doesn't work that way. And that's why people tend to get themselves in trouble very quickly. It's the fact that it does take time. And that's why I also continue to share one of the sayings that I really, really love from one of our trainers and mentors on the Trust Your Talent team, Ryan Carr. He says, it is not about get rich quick. It is about get rich for sure. And so it took me 25 months. However, again, let's just put it this way. Since 2010 to 2021, when this conversation happened, for easy math, I'm just going to say that that's a 10-year period, 1 decade right there. So yes, if I were to keep it and sell it at its peak so far in 2021, I would have made $500,000 more. However, I want you to think about it this way. Had I taken that $500,000 and divided by the 10-year period that I was financially free, I could travel the world, I could do whatever I want. I never had to go back to a soul-sucking, health-wrecking job and working 80 hours a week and not pursuing my personal passions. And you divide that $500,000 by 10 years, that's $50,000 a year only. I mean, what is your mental health worth? What is your time worth? What is the future and the current relationships that you have with your friends, your family, your spouse, your spouses, and your kids worth? And so to me, that was more than worth it. I know had I not been educated, had I not had the mindset that I have today, I probably would have looked at it and go, oh my goodness, that's a lot of money that I just willingly gave away. However, it is all about evaluating the opportunity cost. And now the other thing really is the fact that, as I mentioned earlier, and I need to complete that sentence, many of you send me some very, very beautiful messages acknowledging the fact that in the last 20 years, in North America especially, and also Auckland, New Zealand, Sydney, Melbourne, Australia also, we've seen the craziest inflated increases in property values because of global migration, population migration. So people that are coming in from other countries, immigrations definitely drive a lot of housing demands, and it comes down to demand and supply. And are we going to continue to see the demand being larger than supply? I'm going to say, looking at all the reports and statistics these days, yes. However, is it going to be going up anywhere between 10 to 30, 40% on an annual basis? I don't think so, because so many markets, you understand that this one right here went from $250,000 and to its peak at one point at 920, almost 4 times. However, on average, in a typical North American city, every 20 years, the property value doubles. That has always been the trajectory. And so I want to make sure that everybody understands that this is also not a very typical scenario. It's just that this is one of the main reasons why I see that people from major metropolitan cities, they consistently get stuck in the idea of buying for appreciation. And that's also the main reason why I wanted to do the numbers illustrations with everybody, and specifically for these people, because yes, I get it. 250 in today's dollar, you've paid down 354. If you were to sell it, you are actually getting 800. After all is said and done, you might be taking home 354. Taking out what you actually paid down, it looks like you're taking away 399. However, I'm just also going to add this quickly. Let's say there are 2 listings, one asking for 700, one asking for 800. Without even doing my market due diligence right off the bat, how I would run some high-level numbers if I were contemplating selling it, I would probably take the average of $750,000 just as an average right now. And that's, in my opinion, even on the rosy rainbows and butterflies side of things, okay? And so if it's $50,000 less, obviously that changes the percentages a little bit. However, I'm just going to do some simple math. That means you're taking home 350,000. Remember, had that money not been parked in real estate, because all you have to start with is 20% down, which is $50,000. Okay, so all things created equally, if we just use that $50,000, and then every single month we add $200 into the mix, and we compound it over the next 20 years at just 10%, you would end up with 480,000. Again, huge disclaimer. I am not asking you to save money. Savers are losers. And that's why I say 10%. Who makes 10%? Educated investors will not settle for less than double-digit returns unless, again, your risk tolerance is very different. It's on the lower end. Then there are definitely other opportunities as well. However, at this point, I really want to stress the fact that in this scenario, what's your opportunity cost? Your opportunity cost is that during this 20-year period, you are not having to suffer from getting calls from your tenants to replace the light bulb, to replace any leak from the toilets, to update anything, to fix appliances and update appliances, and maybe deal with potential special assessments. In this case, because it is a condo. However, again, it's not just in a condo scenario or a strata scenario. It's also the fact that anytime you have homeowner associations, there's also that layer of stress and that layer of constraint. For those of you who are confused about what I meant by that, I want you to make sure that you go back to season 3 and episode 11 to learn about why we do not buy or invest in condos unless you are the developer. Okay, that's a very different strategy altogether. Don't call condo buying real estate investing, because it is not. So I hope that you go back to season 3, episode 11 to look at this. Now, some of you, I love this simply because I know I'm getting your attention now. Some of you also message me and go, hang on a second, Tim. This is actually not my take home, because I am not an educated investor, so I don't have the best purchasing structure set up. Okay, so I was buying this property in my personal name. Once I converted that into a non-principal residence, meaning a rental property, when I sell it years later, I am going to be paying capital gain taxes on it. And so again, for my Canadians, you're absolutely 1,000% right. Because let's just look at it this way. As I said, this is the best case scenario based on what we know today. And so at 399,000, okay, we all know the phrase, and funny enough, we all heard of it. However, a lot of people don't understand what it means. We all know that capital gain taxes is taxed at 50%. Well, 50% of what? Well, now you're going to learn about it. Okay, I'm just going to do for simple math. I'm going to bring it up to 400,000. Okay, so your capital gain calculation is the fact that 50% of 400,000 is now taxable. And how is it taxable? It is now taxable based on your income bracket. And to be completely frank, most of you that are watching this, if you're able to, let's say your scenario is not back in 2004, your starting point is the year 2020, 2021, or even better yet, 2023, and then 20 years from now. Regardless, you're probably at a decent income bracket. So what that means is, on a personal level, you have your federal taxes. I'm just using the Canadian tax system as an example. And then you have provincial taxes. And I'm just going to say your income tax bracket is roughly around anywhere between 42% all the way to maybe 51%. So let's just take a happy medium there again, shall we? 45%. This is the thought process, first and foremost, okay? So what that means is you now have a tax bill of $90,000, okay? You now have a tax bill of $90,000. So once again, your $400,000 gain that you thought you were getting is now back down to 400 minus 90, which is 310,000. So 310,000, I really want you to come back here and compare to this particular scenario. Would you rather take home $480,000 and have very little management stress and headaches over 20 years? Or would you rather take home 310,000? You know what? I'm going to write out 310,000 so you can compare. Take home is now 310,000. Okay, let me check my camera to make sure that you guys can see everything. Yes, you can. Awesome. So here's the thing. Here's the real comparison here. And so this is why so many people, they're asking me, okay, you know what, Tim, like I understand and I love real estate. And this is one of the reasons why I don't want to do real estate also, because I feel like it's so much work. I don't want to be an active investor. I would rather be a passive investor. And if I want to be a passive investor, do I still need to get financial education? My answer is always going to be yes, yes, and yes. And 1,000 times yes, in case that's not clear, because you can now see the power also if you want to just park your money, so to speak, and be what a lot of people will call an armchair or passive investor. Once you have access to the knowledge and the community of people that you can trust, that can provide you with the return that you're looking for, your life becomes a lot easier. It's just that a lot of us, i.e. myself, I was an active investor first because I got trained. I was actively doing deals and managing deals. And then slowly, once I also built up my own pot of capital, I am able now to seek opportunities and deals so that I can also transition that into more of a passive scenario. Okay. And so this is why a lot of people, they tend to confuse being an active investor versus being a passive investor, and whether or not financial education needs to be a piece of the puzzle. In my opinion, financial education should always be a piece of the puzzle. Okay. Especially when you're leveraging high value asset classes, because again, you might be able to buy penny stocks. You might be able to buy even the most expensive stocks in the world. I don't know what that is, to be completely frank. However, I understand if you want to buy Facebook, Amazon, and Microsoft these days, it's in the thousands of dollars per share. That's still quite affordable. However, if you want to buy a piece of asset like real estate, even as you know, as far as my knowledge goes right now, let's just take the United States as an example, because you're not going to find those in Canada right now. At least it won't have the other market factors that you want to have, meaning factors that will support rent and ease of getting into the market and ease of getting out of the market. Okay. Even based on my knowledge, you still need to come up with at least $30,000, $40,000, $50,000 at the purchase stage, and you still need to come up with money to close, and you still need to come up with the money to potentially do some renovations so you can go through the BRRRR process, as we've shared with you as well. And so in all things considered, I just really want to encourage everybody to take this very seriously. And by this, I mean financial education. Okay. And so I'm going to just leave that here for now. And I know this episode is probably going to stir up a lot of emotions and also a lot more questions. And so I thank you once again for joining me and for allowing me to walk you through this example in particular. And all questions are welcome. And as you know, every single day during the week, I will be going live at 10 a.m. Mountain Time, and that is noon Eastern Time and 9 a.m. Pacific Time. And so if you're in other time zones, I know if you're in Australia and in Europe, you're in the afternoon, in the evenings already. So I thank you for participating with me and continue to stick with me during my Daily Dose with Tim. And I will let you know, because I am flying to Toronto to speak at the multifamily conference this weekend, the next 2 days, the episodes will not be in this setting. However, I will still be coming to you live, and I will have a couple of live examples to share with you as well. And if you got questions, I might be taking those opportunities to simply do a quick Q&A until I'm able to have a more stable setting as well. Regardless, I appreciate you. Thank you for joining me. And if you enjoy my episodes and my Daily Dose with Tim, please like, comment, and share. I really, really would like to ask you to share everything that I'm sharing with you with others, because I really want to create that impact and start helping people see the difference between real estate buying versus real estate investing. And most importantly, financial education. So have a great rest of the day, everyone. And I will be back here for the next episode. I will see you later. Live well, everyone.